It has been more than a month since April the 2nd, a day in which President Trump termed as Liberation Day, referring to his reciprocal tariff policies on all nations. On May the 8th, the United Kingdom struck a preliminary deal with the United States, becoming the first major economy to do so since April the 2nd. Nothing was signed, but market reacted very positively, and we saw Wall Street rebounding and gold prices starts to pull back. And all this happens 48 hours before representatives of the United States and China meet in Switzerland. Expectation was pretty low, but by the end of last Sunday, they came out with a joint statement saying that they have made progress and has agreed to bring down tariff on each other by 115%. This means Chinese exports into the United States will be levied 30% tariff. Likewise, US export into China will be levied 10% for the next 90 days. Again, nothing was signed, but market reacted very positively as this represents a de-escalation in their trade war. Wall Street resumed its rally and gold price pulled back even sharper. From the month high of $3,448.20 per ounce, gold prices dropped to as low as $3,123.30 per ounce by Thursday. This represents a move of $325 per ounce or 9.4%. Pretty sharp. Then on Friday, before the market closes on Wall Street, Moody's, a major credit rating agency, unexpectedly announced that they are downgrading US credit worthiness by just one notch, becoming the last of the three major credit rating agencies to do so since 2011. Now the million-dollar question is, how will the market react when it opens on Monday tomorrow? To answer this question, we will have to refer back to the charts. Now, as we look into the futures market relative to the COMEX futures, okay, for gold, we want to take reference from the regular gold contract, which is the June regular gold contract. The symbol is GCM5, okay? So we use this as the basis for analysis to look at the bigger picture here. Now we are seeing gold prices peak out at $3,509.90 and has unfolded in a three-wave pattern, which has hit a low this past week on Thursday at $3,129.30. Now this finished a very classical symmetrical three-wave pullback into the equality range between $3,076.80 to $3,147.70. It is as textbook as it comes because this follows a rebound from within this bracket of prices. And although Friday did not see a follow-through buying, but that has essentially satisfied its minimum three-wave pullback scenario. If that's the case, because the underlying strength is still favoring to the upside, it could be a case of the market having finished its corrective pullback at the bare minimum, assuming this is a very simple corrective pattern and the market is poised to resume its uptrend, possibly beyond $3,509.90 over time. So what it means that this level is actually suggesting that perhaps a end of the correction is over. So when we look into the lower time frame, for example, we look into the ABC move, right? This is an ABCD move. If we look into this situation here, a break of this near-term resistance line may be all we need. Okay, all we need is a close on the daily time frame above here to confirm that this pullback is over and the market is getting ready to resume its overall bullish uptrend. Okay. Then when we look into the 4 hours time frame, the three-wave pullback can be clearly seen here. Okay. And now that we have a bounce from here, followed by a relatively sharp pullback, once the market resume its upside beyond $3,255.80, at least we have a near-term target. If we're going to do a short-term play, buying anywhere near current price, then I would suggest that the target is likely to be somewhere at $3,288.90 at the minimum. So this is based on a 4 hours time frame. So it could be a setup for such. Now on the lower time frame, I already have a buy signal trigger at 3,180 based on the regular gold futures contract for the June delivery. Okay. Again, my target is at $3,288.90. However, the margin requirement for this regular gold contract is a little bit prohibitive for the regular retail investors. Currently, maintenance is at 15,000 US. So it is not something that a lot of retail investors have. So maybe I can suggest the next best retail products for trading gold based on this scenario here. Okay. Now this is called a micro gold futures. The margin required is only 1,500, not 15,000. Okay. So here we can see the three wave move on a 1 hour time frame. I have a trigger here that has already say that I should go long at $3,180.10. So my target for a bare minimum short-term move target is at $3,289 per ounce. So it's still very, very lucrative. If I do this trade based on the entry here and my stop below $3,123.40, I have a risk reward of 1 is to almost 2. Okay. Not the best. Remember, this is at least the minimum that you can gain for, with the possibility that a long-term low is already in place. And if you base it on the daily time frame, a challenge of an all-time high beyond $3,500 is a real possibility. So beyond the near-term target here at $3,289, there's a possibility of the market resuming its overall trend beyond the all-time high. Okay, so this is based on the micro futures. Okay, for the June contract. Now, in a lower time frame, such as 5 minutes, for example, I already have this, okay, a trigger at $3,176.60. Of course, the price has already moved quite a fair bit, but it just goes to shows the potential of trading gold even on the lower time frame, such as 5 minutes. Obviously, you have to really eyeball this trade as it unfolds. Now, the target for this move here is for a minimum at $3,225.60, okay, which is not very lucrative based on where it closes on Friday. But this would give you an example on the potential. If you can spot the reversal early, this could be something that you may want to consider. Now here, the risk reward is very superior. Earlier on, based on the 1 hour time frame, the risk reward ratio is 1 is to 1.9, meaning for every $1 you're prepared to risk, there's a potential reward of $1.90. However, in the 5 minutes setup based on the entry of $3,176.60, okay, the risk reward is almost 1 is to 6. Meaning to say that for every $1 you're prepared to risk, there's a potential for $6 reward, which is superior. And this is a micro contract, which is very, very suitable for the retail investors, assuming you can cough up a maintenance margin of the minimum $1,500. So it's not a small contract, but it is realistically achievable for the retail investors. So based on this setup that I just shown you, I hope to be able to provide you with some idea as to where the immediate direction of gold is likely to be. Okay, and that's all for this week, and I shall see you in another update. Bye bye.